Good afternoon and welcome to our technical webinar on PE exits via the stock exchange. Deal making is at the center of our industry. It follows a thorough process and completes an entire cycle. Great acquisitions, efficient business transformations, but in the end, the exits should not be neglected. When we hear exits, it usually means selling the asset further to another PE buyer, and certainly also includes trade sales for a high proportion. But what about the IPOs, the public markets routes? What are the trends and dynamics at play? Why go public? What are the challenges and changes you need to plan ahead? Lucky you, today's panelists will shed more light on the specific process and with concrete examples and guidance. Darshita Shaw from KPMG will be today's moderator, and she will introduce you to the different speakers. As usual, do not hesitate to ask the different questions via the chat function or Q&A button. Darshita, the webinar is yours.
Hi, everyone. Welcome to the webinar. We are joined today by, firstly, we have two people from Euronext, Benoit van de Hoof and Thomas Barsch. They're both going to be taking the next session on the market dynamics. Presently, Benoit has been working with Euronext for a while. He's the head of listing Belgium there. He's got a wide experience of financial markets from a legal and financial point of view. Thomas Barsch is the equity listing and sales associate at Euronext. The two of them will be taking the next 15 minutes of the seminar, explaining, giving us some good insights into the market dynamics. I'd like to now pass on to you guys. Thank you.
Thank you, Darshita, for this kind introduction, and thank you to the LPA for having us as speakers today. So let's start with this presentation on the dynamics that we see today in the capital markets, and from a primary markets perspective first. What we see is that at the level of the stock exchanges, there is a concentration which is going on, especially at the level of Euronext. We have now 7 venues that we run throughout Europe, but also we see that some other players are concentrating themselves. But at the level of Euronext, that represents 1,850 companies which are listed on public markets, representing more than 5 trillion of market capitalization globally. And out of those 1,850 companies, 670 are tech companies and 1,400 are SME listed companies. So that's quite a lot of more smaller companies which are listed on a Euronext venue.
So just a quick presentation on how Euronext stands among competition. You can see LSE and Nasdaq being the top competitors. And what's interesting to mention here is that although Euronext is split across several countries, you can see that everything is taking place under one single pool of liquidity, and that's very important. That provides more interconnection among investors, and also you get a larger in-depth market and more quality. So these are very important notions to take into account. Now, if you want to have a look at what's the market dynamics at play and key sector trend that we see, we've compared Euronext here in green with London Stock Exchange in gray and also Deutsche Börse in blue. What's interesting to highlight is the fact that you can clearly see the negative impact on the Brexit that the Brexit had on LSE starting from 2018 until now. And the other way around, Euronext beneficiated and had a very positive trends since that. On the other hand, Deutsche Börse, it's a bit more erratic and volatile. Sometimes they had very big industrial joining the market, and that's why sometimes you see numbers popping up. So also what's interesting, 2020 has been a very good year for the listing. And also 2021 is on track to be a very good year in terms of numbers and total market cap. Now, if we go beyond those global pictures, we can see some very specific trend occurring on the market. And this is being highlighted on the right-hand side of the slide. Clean tech has been performing very well. You have an example here with Ecopac, a clean tech company that got listed earlier this year. And to give you a clear example, out of the 58 listings we've had so far, 21 were clean techs. And last year, full year 2020, we already had 21 listings on the clean tech as well. So the trend is very positive. You get another one with the pure tech players, and Unified Post got raised over 250 million. So the tech has been performing extremely well, and as well for the life sciences. So the trend is very positive. And if you look onwards, you're looking for at least another decade of very strong growth, and investors are willing to pay a strong premium to have access to those very fast growing sectors. Now, another hot trend that we've been seeing lately is not so much related to a sector, but rather to a type of listing. And these are, of course, the SPACs. So special purpose acquisition company, we should rather call it vehicle. So here we show only the European numbers. The US has nothing to do with that. Last year, they've raised over 80 billion, for instance. You can see it's a complete different momentum. Nevertheless, it is positive trend in Europe. You can see since 2019, the numbers of SPACs have raised, but also the deal size has increased, meaning that there's more money being poured into those types of listings. Key sectors are the one that I've mentioned before. So clean tech, everything related to ESG and tech are the key targeted companies among SPACs. Now, keep in mind that SPACs should be seen as a tool that you have in your toolbox. It's not meant for every company. And also the company that you will purchase at the end, is it mature enough to fit a listing? There's many questions that can be raised out of those types of listings. Now, another very interesting trend that we've seen starting in 2020 is the comeback of the retail investors. Here you can see the activity has peaked in March and April, matching the health crisis. But what's even more interesting is to notice that we thought the trend will very quickly fade away. But actually, the retail investor get back on the market following the second wave of the COVID in September and October. And actually, even as of today, we still see a high activity of retail investor, and that is very interesting, although not as high as March and April, but above pre-COVID level. And that is interesting because that brings you diversification effect on the investor base and also more liquidity, which are key concerns, of course, for companies and investors. Talking about investors, what's even more surprising here, if you look at the geographical standpoint, who invest into Euronext companies, looking at the institutional investors only? Well, surprisingly, you get 44% of them being American. And if you add the British, then you get over 60% not being Europeans. That is very, very important. That shows you do not need to get listed abroad to have access to international investors. You can have access to them by being listed in your home market. So now one might say that, okay, but you have dual listed companies, so that increases the numbers. But even by removing them, you will have a large part being American and British. And keep in mind that dual listed companies have most of their trading and their volume on their own market. So that makes these numbers relevant in any case. So why is that? Well, because European companies are very attractive to institutional investors. And that's what you see on the lower side of the slide. Investors come to get growth. This is the main strategy that is coming out of the investors. So you can see the attractiveness, I would say, of international investors. Perhaps I will leave it to you, Benoit, on the IPO. Thank you.
Thank you, Thomas. And so why would a company list? And we identified 4 main reasons why a company would list. Well, first of all is the financing of growth. And Nyxoah was already mentioned. Nyxoah is a medtech company, and generally speaking, life science companies, but also tech companies, well, they need a lot of investment. And so to finance the future growth of the company. And that's one of the first topics. The second reason why a company would go public, besides financing of growth, is increase its visibility. And the company Ecopac that was already mentioned, well, they told us literally the day that they announced their IPO intention. Well, they got a lot of feedback from potential suppliers, from potential employees, potential clients who wanted to get in touch with that company, and that strongly increased its visibility, and to a bigger extent than what they expected. A third reason why you would go public is to ensure your independence. Well, if you look at companies like Unified Post, they went public for the first reason being to finance the growth, but also to keep its own independence. So the company is owned partially by the founder, and well, they keep on in the driving seat of the company, and they will be able to finance future acquisitions and to grow in, and they will be the one which will do the M&A, and they will not be subject to the M&A. At least that's their intention through their IPO. And finally, the strengthening of the credibility. You have a smaller company like Choice, which listed in February of this year with a relatively small market cap, 26 million euros. Well, the stock listing was for them a possibility to increase their credibility, showing that they have a strong governance and a strong way of going to the client. So those are the four main reasons why a company would go public. And if we compare this with other tools which are available to companies like a trade sale or private equity transaction, well, we see that the IPO brings a lot of benefits. I, of course, mentioned already a few of them, but one which is interesting is the liquidity. And especially for the historic shareholders which invested since the start in the company, well, the IPO is a possibility to do a sell down of their participation. They can do it either at the IPO, where part of the proceeds of the IPO go back to the shareholders. But they can also do it post-IPO through block sales, meaning that once the company is listed, well, you have a venue on which you can attract investors, and the historic shareholders can do partial block sales once the company is listed. Another topic which is also very important for companies in the war to get the best talents on board, while having listed companies is also a way to reward, retain, and incentivize your staff and your management through the offering of plans where people can either have stock options or share purchase plans. So that one is also very important in this respect. And what we see is that, generally speaking, well, the IPO brings a lot of these benefits, which the other solutions have maybe less than what the IPO can bring. So how does it work? What are the main steps towards the IPO? And generally speaking, we say it's a process of approximately 6 months, starting from the kickoff. Then you start structuring the transaction with defining the equity story, starting the discussions with the local regulator. And at that point in time, well, the pricing remains quite a wide range. Because the analysts, the teams need to understand better the functioning of the company, and the more those people progress into the preparation of the file, the more that this price range is refined. But also at one point in time, well, 1, 2, 3 months before the start of the IPO, they start talking to investors, so that's the blue arrow at the bottom of the page. And at the start, it's only a limited number of investors that they meet, 5 to 20, and they get feedback from those investors. The analysts of the bank who will provide the research, well, they also have the view on the company and its value. And the more we progress, the finer that the price range gets. And but also the more interactions that will come and follow with the investors, and that will allow the company to draw up its price range for the IPO, which is approximately 50% around the central price. And then you start the IPO, and you meet, well, hundreds of investors, especially today in digital times, where you can meet very efficiently a lot of investors. And all those interactions, well, they crystallize into the IPO pricing, which is the price at which the company goes public on its listing day. How would you do that for a company which is owned by private equity? Well, you can do it in different ways. So either you can have a process where you start a trade sale, where you try to find potential buyers for the stake that you have into the company. And then if it fails, well, you go for the IPO. The other route is well, that you do both tracks together in parallel. And the main advantage of the second route is that you well, you have two tracks which will bring some competition between the two processes, and which will bring a healthy pressure on the trade sale process, and which will most probably allow to maximize the pricing. Or the pitfalls of that way of working is that you have increased management mobilization, but also some higher costs to a certain extent. But it will allow definitely to bring more dynamic and more pressure, healthy pressure on the two tracks. If you go for the first route, the main pitfall is that well, if it is known in the market that the sales process was failed, then it might appear as being a way to try to divest something that no one wanted to buy in the private market, and that's bringing some negative vibes around this file, and that will have a detrimental effect on the IPO process and the IPO pricing. Then when we look at the seasonality, so when do we have IPOs? Well, basically you see that throughout the whole year you have capital markets transactions. So this is based on IPOs between 2013 and 2021. So these are historic figures, but you see that apart from the months of January and the months of August, but still in those periods you have sometimes IPOs. Well, the IPO window is open the whole year round, so making it quite easy to get access for a stock listing for a company. So that was the introductory part that we wanted to bring to you to explain well how the dynamics work. And now I think it's time to go back to Darshita.
Yes, thank you so much, Thomas and Benoit, for this very informative information. If any of the participants have any questions, please note them down. We will have a small window towards the end of the present webinar for any questions that you have. I think we can now move on to the next presenters. We have Jacques Grasse and Paul Pepote from Allen & Overy. Jacques is an M&A partner specializing in cross-border public-private M&A and corporate transactions. Paul is an international capital markets partner at Allen & Overy, and he advises on a lot of capital markets related legal advice for debt and equity, as well as securitization transactions. They will give us a small brief on the legal requirements and consequences of a stock listing. So I now hand it over to you, Jacques and Paul.
Thank you very much, Darshita, and welcome everybody. Although we are still not looking each other in the eye, but only talking through the virtual world. So after the presentation from our friends at Euronext, unfortunately, even in particular also in IPOs, you need to deal with lawyers. So the legal considerations, however, are not only a necessary evil, but they are really paramount to achieving the financial the desired financial outcome. And the financial success of an IPO also depends on making sure the structure, the legal structure, is in place. And this is particularly true when you talk about a PE background and a PE planned IPO exit, because as you all know, a PE investor has a cycle of investment, and following that cycle, which is typically 5 years, but you now in the market see is also sometimes shorter or longer periods, the exit has to be structured. And if you want to maintain the optionality for an IPO exit, that actually needs to start at the time of the investment, and we'll talk about that a little bit later. Why do you have two lawyers? One would already be sufficient. Some of you may say, well, unfortunately or fortunately, depending on the perspective, these are very complex topics, and you really need to combine a corporate M&A expertise with also a more capital markets and regulatory expertise, which is something that my partner Paul covers. So we talked about the key legal considerations, and we basically look at this now at two stages. As I say, there's the initial investment stage, and then in a second stage, the actual IPO implementation phase. When we talk about the initial investment stage from a PE perspective, it is the time you buy a target, the time the PE sponsor negotiates shareholders agreements, MIP arrangements, and normally the PE sponsor is not alone as a shareholder in the structure. So what is really key is to make sure upfront that through contractual undertakings, in particular drag-along clauses or other contractual covenants, you are able to control 100% of the share capital, or at least get those people out that may potentially block the IPO path at a subsequent point in time, because doing an IPO without everybody on board is something that would be extremely difficult to achieve. Beyond that question of the ability to control the shareholdership, it's also more generally the ability to control the IPO process. So it's already at the time of the investment, again, this is 5 years before you potentially would do an IPO, that you would give yourself as a PE sponsor the right and the ability to freely launch an IPO process, to choose an investment bank, to choose the listing venue, and to generally speaking organize the process. And as a third item, maybe Paul, you can comment on that, is the impact of the finance documentation.
Yes, indeed. Thank you, Jacques. I think the point we wanted to make here is that indeed at the time of the investment, which is probably then financed not only via equity but also via debt, that it needs to be made sure that this financing, the corporate structure that is put in place to finance the acquisition, which is typically made up by a number of Luxembourg holding companies, is made such that there is still room for using one of these Luxembourg holding companies to convert it into the actual IPO vehicle, and therefore it is key at the time of entering into the finance documentation to make sure that there is such a potential holding company, and that you do not end up with a scenario where all of the shares of all of your companies are being pledged, which would make the IPO process difficult, as you would have to negotiate with the finance party before proceeding.
And so if you have done all your homework at the initial investment stage, and indeed at the subsequent exit stage, you decide to go for an IPO or potentially dual track where you've pursued the IPO plus the classic industrial or other exit, there are a number of key considerations or key legal considerations that come on the top of the considerations that Euronext was already mentioning. And the first one is a corporate topic, because very often PE investments at the initial stage are structured through ZAL type structures, or you see also lots of SES these days. But if you want to do an IPO, you need an SA. And in most IPOs that are the result of PE exits, there's a need to actually convert companies into an SA to make the articles IPO fit. And there's a specific focus on corporate governance, because obviously you will have a very different governance model in a privately held company, tightly controlled by a PE sponsor, even if there's a strong management on the side, than in an IPO company. And these discussions can be quite time-consuming and complex, so need to be taken up front.
I think the next element is the prospectus. I think it's fair to say that this on the legal side will be the document that will involve most of the overall preparation time. The prospectus is a document which is, well, it is required in order to be able to do a public offering of shares and also to request the admission to trading on a regulated market. It is obviously also a marketing document, and as such it is governed, if we look at European deals, by the European prospectus regulation, in that this document must contain all information that is material to an investor in order to allow the investor to make an informed assessment of the issuer and of the underlying securities. Its content is regulated in detail by European regulations. There's specific delegated regulations that just deal with the content. And In terms of approval, so the prospectus allowing the public offer and the admission to trading must be vetted by a competent authority. What is interesting to note here is that for equity, there is actually no choice to select a competent authority, meaning that if you use a Luxembourg holding company as IPO vehicle, you will have to have the prospectus approved in Luxembourg by the Luxembourg CSSF, insofar as you carry out a public offer within the European Economic Area, within Luxembourg or outside Luxembourg, and or whether you request the admission to trading on a regulated market within Europe. It's interesting because you will face the Luxembourg CSSF, whether you carry out a public offering in Luxembourg and do a listing in Luxembourg or not. And I think it's fair to say that very often you would see deals that are structured via a Luxembourg holding company where the admission to trading is not done necessarily in Luxembourg, but the public offering and the admission to trading will be done in a market that is very often close to the underlying business. Let's put it this way. But nevertheless, CSF will be involved. That applies insofar as there is a European process, and in terms of process overall, what we see is that the Luxembourg CSSF would take by law 20 business days to review prospectus before providing a detailed set of comments. In practice, this is usually quicker, but nevertheless, there's a larger timeline that needs to be taken into account in order to have the prospectus vetted by the competent authority. In terms of choice of listing venue, there is no particular requirement, so you can really freely choose the relevant listing venue, but that is, I think, then driven mostly by what Benoit has been mentioning. If the IPO is entirely focused on non-EEA jurisdictions, in the sense, for instance, that there's a public offering in the US and also a listing in the US, then of course all of the rules on prospectus regulation that I mentioned would not be relevant, and you are looking at a very different regulation. In terms of technical setup, what you will also have to think about is to appoint a relevant, let's call him issue and paying agent, in order to get the shares cleared via a clearing system. That will be required in order to have access to a trading venue in Europe. And I think what we see in Luxembourg for Luxembourg companies that do an IPO is that they would more and more issue dematerialized shares governed by the Luxembourg law on dematerialization, and those would be lodged with typically a purely Luxembourg clearinghouse, which is Lux CSD. And then you would then basically bridge the gap from Lux CSD with other clearing systems in order to make sure that the shares are then distributed through the varying clearing systems into the relevant jurisdictions.
Yeah, and indeed, what Paul was just describing is sort of the setup from an operational perspective, and at the day of the actual IPO, which is normally a new share issuance, unless it's a pure primary issuance, but in a PE driven exit, you would typically have new shares that are issued. There's of course then also a Luxembourg corporate law process to issue such shares, which is a pretty classic process where you would rely on the authorized capital provisions, which need of course to be thought through upfront to allow for sufficient volume, and which also need to anticipate future possible issuances, employee stock option plans, shares to be used in M&A considerations. So there's a very strong interaction between the legal teams and the business teams to make these things happen. And while we are, of course, all accustomed in dealing with board meetings and notarial processes, if these processes fall together with the actual launch of an IPO, where you also need to interact with a number of other actors, it adds to a quite significant complexity. And there, Luxembourg, I would say, has really developed also a market practice, which is something to also be used in the terms of marketability of Luxembourg as a jurisdiction for IPO companies, considering the large flexibility that exists throughout this process, the large flexibility in terms of choice of listing venue, as Paul mentioned, and last but not least, also the interaction with the CSF that, at least compared to certain other regulators, is considered as more friendly than others. Well, maybe Paul, over to you just to give a bit of an oversight of the key documents, and also underline that this is not a bread and butter process, but requires some hard work.
Indeed. So here on the slide, you can see a list of, well, let's say, key documents that will need to be set up for each IPO. We've already talked about the need to do a reshuffling of the articles of incorporation of the Luxembourg holding company that will be the IPO company, and related corporate steps. I think Jackie also mentioned the need to look into the corporate governance regime, which will obviously also be closely linked to the various listing requirements on the relevant market. And we talked about the IPO prospectus, which really is, as I said, the key document where we would usually spend most time. And actually, before the lawyers start really drafting this document, there's a whole due diligence exercise that needs to be made on the company side in order to make sure that whatever is included in this prospectus in terms of business disclosure is appropriate and accurate. And so that's a preparatory work that does not need to be, that should not be underestimated. I think in terms of key sections that are much negotiated in these prospectuses are certainly the so-called MD&A section, the management discussion and analysis, which will be heavily discussed between the company and also the bankers that will assist in distributing the shares once the public offer is launched. And another element that I think is key, and which also requires preparation in advance, is the financials that will be included in this prospectus. So although the European prospectus regulation just says that you would include 3 years of historical financials of the company into the prospectus, I think it is clear that very often the underlying businesses have evolved over the last years, and therefore they end up with what we call a complex financial history, which would then in a number of cases require the production of additional financials, such as pro forma financials. So there's a whole range of preparation work that is also required on that front. Maybe turning to the underwriting agreement, which is the key agreement between a company and underwriting banks, whereby the banks will in some form commit to assist in the distribution, if I can say, of the shares, and if failing so to basically take over the underlying shares in connection with the IPO. So that agreement is obviously going to be negotiated in terms of having a detailed set of representation and warranties by the company and other related entities, whereby the banks will make their arrangements conditional to a compliance with all of these representation and warranties and a number of key conditions precedent. Publicity and research report guidelines will be documents established quite early in the process. The publicity guidelines will be the guidelines assessing how let's say the working group that is focusing on the preparation of the IPO can, if at all, communicate with the outside and what information can be shared, whilst the research report guidelines will be setting out how there can be any form of communication with basically outside banks who are preparing any form of research reports on the prospect intending to do an IPO. Custody arrangement, clearing arrangements, we have already talked about. There will also be comfort letters that will be needed, especially by the underwriting banks, whereby the auditors will do what we call a circle up of the prospectus, in the sense that they will be checking the various financials that are included in the prospectus and will give additional comfort to the underwriting banks in terms of the financials included in the prospectus. And of course, lawyers' legal opinions are also going to be produced and will be required as part of the CPs of the underwriting agreement, whereby the lawyers will confirm that under applicable law, the agreements are legal, valid, and binding, and that the new share issuance is also valid. Lastly, listing applications will have to be dealt with, as well as any requirements that are specific to the listing venue. So that is also something to be addressed at an early stage.
Yes, thank you, Paul and Jacques, for this very informative information on the actual process of an IPO. I'm sure we all have a lot more insights about the key dynamics and the process that goes around when one company has to do an IPO. Of course, having knowledge and actually practically doing the IPO are two different things. And we have one company's CFO with us who is here to explain us the practical aspects and the difficulties and the actual process that they went through to list themselves. We have with us Jean Kriusch from Shurgard, who's the CFO of the company and has been so for a while. Hi, Jean.
Good morning, good afternoon, or good evening even.
Yes, we are very glad to have you here. So for all our participants, we are going to have a very short session with Jean covering a few questions that we already have. And we are open to any questions that all the participants have. So please feel free to use also the Q&A tab of this meeting to ask any other questions that you have. We'll have this short session with Jean, followed by which we'll have a generic Q&A for all of our panelists as well. So Jean, firstly, very, very big welcome. I think we can start since we are already running short of time. So our first question is just a short introduction of Shurgard for our participants to understand what the company is, how long it's been along, and what does it do exactly.
Okay, Darshita. So we are the leader in self-storage, and maybe I'll quickly share my screen. So Shurgard, we are doing self-storage, and what is self-storage is actually think about having your basement or your attic in a remote location. That's what we do. We rent space. We rent space to mainly residential customer. 80% of our customers are residential, and 20% are business customers. So that's our main, I would say, our main business. If you look at Shurgard, we are the largest self-storage operator in Europe. We have 240 stores spread across 7 countries. We have more than 1 million square meters of total net rentable area and about 165,000 customers. Our portfolio is quite unique in the sense that 93% of our stores are in capital cities or T1 cities, and this is quite important for us because obviously people need space when that rent small apartments, and in those cities the square meter that people have is a lot lower than in other cities. Typically, those cities are also more resilient in terms of in recession. So we're located where there is density. Density is a key matrix for us. We're also a real estate company in the sense that we own 94% of our store, so quite heavy from the balance sheet point of view. Some geographically diversified, as you can see. I mean, France, Netherlands being our biggest market, followed by Sweden and UK, and then a smaller footprint in Germany, Belgium, and Denmark. And some financial, 271 million euro of revenue. Adjusted EPRA earnings, which is equivalent to FFO, is about 118 million euro. We have a very low LTV for a real estate company, 18%, and enterprise value of 3.7 billion. Since we went public in October 2018 on Euronext Brussels, our share price moved from 23 euro and is currently above 40 euro right now. So we had a good, I would say we had a good run.
Yes, definitely. We can all see that. And we all know whom to go to if we run out of space in our basements or our homes now. Thank you for that short introduction, Jean. Yes, you went in for a listing in 2018. I understand from my colleagues here that, you know, Shurgard also tried to go public before that once. We'd like to understand why did Shurgard choose a public IPO listing instead of, say, another private round in 2018?
Yeah, well, as you said, back in time, so Shurgard US was the second largest operator, and in 2006 was bought by the largest operator of self-storage in the United States, Public Storage. They were number 2, and as a result, Public Storage also bought Shurgard Europe because we're a subsidiary of Shurgard US. Back then, in 2007, we tried an IPO, and the view of the chairman of and CEO of Public Storage, Ron Havner, has always been to manage Shurgard Europe independently from the US operation. So he said, you know, IPO will be a good way. That did a dual IPO and equity or trade. And we had the crash in 2007, so they didn't get the price they wanted. So they decided to do a JV with the New York State Retirement Fund, a pension fund, rather than going public. They felt that they would have, or more actually, they got a better pricing going that route. So for about 10 years, we were private. With 2 main shareholders, 51% the New York State and 49% Public Storage. As part of the agreement, the only exit for New York Common was an IPO. At that time, back in 2007, 2008, the investment horizon was about 10 years. So in 2018, we went for the IPO. And why? One, I think, as it was mentioned by Benoit, we had similar, I would say, reasoning. The first one was to strengthen the independence. Even though we were run independently, that thought it would be even better to be public. Management will have more skin in the games through options and so on. Second one, obviously, was to allow New York Common to exit if they wish to do so. At IPO, they decided not to exit, so we only did primary issuance. And so far, they haven't sold yet. I mean, they have seen the stock price rising, so they're quite happy. But they have the possibility to exit if they wish to do. I think another element was to have a better valuation of the company, so increase the visibility. Prior to that, it was private valuation. Now we're public, so really we have and our valuation has improved quite significantly. And in terms of ratio, when I compare where we stand versus our competitors, we are now at the same level. While with the private valuation, we were valued lower. And finally, I would say it's access to capital to fund our growth. We have a quite ambitious growth plan by adding about 10 properties on a yearly basis, and we have better access to capital now that we are public.
That's great. I think Shurgard is going on a very good track at the moment. I think another question that we had was okay, a private environment and a public environment are surely very different. So what, in your opinion, are the key changes in the daily working of the company? Because of course, being public involves more transparency, more regulations, requirements of more procedures in place. So can you just shed some light on that?
Yeah, so actually it is a big change. It's not to underestimate the change it brings to the daily life of the company. I would say the first impact is staffing. I mean, we increased our staffing, new role. I mean, you need a director of or someone for investor relations. So we have a director investor relation. Also, we had to strengthen our legal team. So we have a corporate lawyer that's really following up on external and internal regulation, as Paul and Jacques covered early on. I think where we were lucky is because Public Storage is already a public company. From a finance team, we were already very well prepared. So we were used to quarterly reporting, from that point of view. So we kind of already had a rhythm, but clearly you need to speed up that rhythm. An area where we were weak and we had to improve quite significantly is tax reporting. Because suddenly tax, and for us, tax we're in a tax-paying position, so it's an important line of our P&L. And I would say, as a private company, you kind of look at that more on an annual basis rather than a quarterly basis. But as a public company, obviously, tax is a key element. So we also had to strengthen that team, mainly for reporting purposes. Second area where life is changing is communication with the market. It's also very time consuming. I would say it takes up about 20% of the CEO and my time, which is quite significant. So I think when you consider going public, make sure that you have a robust organization behind you, because you will not be able to spend as much time as before on running the company. So you really need to make sure that the company will run quite well, and you have the organization behind. Indeed, I mean, you get into quarterly reporting, you have earnings calls with analysts, calls with investors, you go to investor conferences. So all of that takes time. You need to prepare, you need to have, delivery of your story, which is very key. So the market understands well your result, and all of that is necessary if you want to support your stock price. And I would say, finally, ESG. As a private company, most private companies is not on the top of the agenda, but the sustainability nowadays, and it has increased dramatically in the 3 years that we've been public. But clearly, the amount of reporting around ESG, certification that you need to do, reporting of key metrics, and all these processes that you need to put in place in order to be decently rated. I mean, not even say a great rating, but to be decently rated by the various ESG ratings agencies that are out there, because there's not, unfortunately, there's not only one, but there are several. So it is very heavy and it's costly. And it takes time, and not only time of, like, on the finance side, of limited amount of people or communication to the market, which you can limit. Here, it really eats up a lot of time across the organization.
Right. So I guess all the benefits of pricing and visibility come at a big administrative burden as well.
Correct.
Right. And just following up on that, what's in your opinion the most challenging part of this IPO? Because of course there are 100 things involved. The process is long and time consuming with a lot of stakeholders. So practically, what is the most challenging part in your opinion?
Well, to reassure Jacques and Paul, it was not the lawyers. But I would say from a point of view, one was more of a technical one. We were reporting under US GAAP, and we had to translate all our accounts into IFRS. So that was key, and as mentioned in the presentation before, prospectus is a very important and part of the IPO process. It is very heavy as it is. So if on top of that, you need to make some adjustments in your accounts, make sure that you're prepared well in advance. So I would recommend really to think and get ready a couple of years in advance and making sure that you have the right accounting already and the right accounts prior to the IPO launch. And then I would say to me a challenging but in key elements in the IPO preparation is to get the equity story right. I think we were very fortunate to have the right team of advisors, but we clearly spend a lot of time with them, with our shareholders as well, in building the right story and having the right tone. I think it's not only important in order to get a good pricing at IPO, obviously, but also it will be the basis for the story for the next years. And the investors will be tracking your performance based on what you said at IPO. So you really have to make sure you can get that right, and then that you afterwards that you will deliver on what you promised at IPO. And if you can do that, then you can have a good run in terms of stock price.
Right. I think these are most of the questions that we had. I think some of our participants also have some questions for you, Jean. Mm-hmm. First one is, was the IPO worth it in the end? It looks very burdensome, so I hope the answer is yes.
Yeah, it was worth it. I mean, as I said, I mean, if you look at the valuation of the company 3 years ago, I mean, our stock was at 23, we had 40. So clearly strong improvement from that point of view. I think being public, it is burdensome. I mean, we cannot hide, and I won't say it's easy. But if you're already well organized, it's manageable. And you also get a lot of benefit from the market. I mean, that keep you on your toes. I mean, every quarter we have meeting with analysts, with investors. We always have good questions that are challenging what we do. So from that point of view, we also learn a lot.
Yes, that's great. This question was from Lisa, so I hope Lisa, you have your answer. It is yes, as you expected. We have another question from Haider. It is, to which extent is the SPAC IPO rather than the de-SPACing process more attractive than the normal IPO process?
The what, sorry?
The SPAC IPO, the special purpose.
I don't know. I mean, we did a regular IPO from a point of view. So maybe Benoit can answer that.
Yes, exactly. That's for Benoit.
I'll take that one. Maybe the colleagues from ANO may want to complete afterwards. But the main advantage for a SPAC IPO is that you outsource the process. So you have some sponsors who prepare a listed vehicle, and so they go through the regulatory process that was explained by Paul, by having the prospectus approved, the company created, etc. And during a lifespan of approximately 2 years, that company is looking for a private target with which it will merge, and then at that time the consequence of the merger is that private company becomes a publicly listed company. And the main advantage is that it's quite smooth. It goes quite quickly for that company, because they don't have all the preparatory work which was done in advance by the sponsors. but also they have a security on the price because well, they negotiate the price only with the sponsors of the SPAC. They don't have to run through the whole process that I explained, which takes well, quite some time, and which was also explained by Jean, all these interactions with the investors. But on the other hand, the company has to be prepared to become a listed company because it becomes very quickly a listed company, and so it has to be well, IPO ready by that time. And then all the interactions that they didn't have with the investors during the IPO process, well, they have to build them afterwards once the company is listed, because they have to create that relationship, that bond with the investors, and so they will have to invest heavily into the investor relations afterwards. Maybe Paul or Jacques, you want to complete?
Yes, sure. Thank you, but I think that was already very exhaustive. I think the main point is really on the prospectus. I think the purpose is different in the sense that if you proceed with a SPAC IPO, the purpose is not to describe an existing business that where you make due diligence and you have a description of what the financials of an existing business are, but rather it's description of an investment policy, let's put it this way, and of certain people who will be potentially have the possibility to identify relevant targets. So on that basis, the prospectus to be approved by the regulator is slightly different, and it's probably also going to be a little lighter compared to an ordinary IPO. But as you said, I think it's a different process. Let's see how this trend will evolve over the coming months.
Yes, exactly. Thank you so much, Benoit and Paul, for your answers. I believe we do not have any other questions, but there's one question from me, since we were already talking about SPACs and the high rise of these. Benoit, what do you think is the impact of this high rise of SPACs on the equity markets? Will this change the access to these markets?
Well, that's a very good question, and I think that we'd all like to have the answer to that question. But what we see in the US is that you have well, for tens of billions of US dollars of SPACs which are chasing for a target. So definitely in the US there's a lot of traction, but also a lot of competition between all those SPACs which would like to go up to the de-SPACing. And so that competition is driving the prices up, and so the expectation is that some SPACs may pivot and chase in Europe. But what we saw is that for European targets which were taken over by US SPACs, is that the performance after market is rather negative. When you have a European SPAC merging with a European target, generally speaking, the performance is very good. US SPACs merging with European SPACs, European targets, that's most of times a rather negative performance afterwards. And what we see also these days is that in Europe, many SPACs are being launched. We had again a few this week on Euronext in Paris and in Amsterdam, and so the expectation is that this will become a new tool to help companies to go public and to have access to the capital markets. But maybe it would be interesting to have this discussion again in 1 year or in 18 months to discuss what happens.
Just to add one point, which is that the SPACs actually not something new. They have existed for quite some time, but it's now become an additional or more popular means. And so the question is whether that sort of hype is sustainable. And I think you, Benoit, made a very good point about the run to targets. At the end of the day, launching a SPAC is not the difficult part. The difficult part is a successful de-SPACing. And so the real success is something we'll see in 12 to 18 months. And if you look at the number of SPACs being launched, the market is, it's getting crowded. But okay, it's always the question: is it too late to join the frenzy or not?
Right. One more question would be, what, in your opinion, are the costs to be envisaged in this entire process? I'm not sure who should take this, maybe Benoit or Jean, one of y'all who is more familiar can
Yes,
give us more
thanks,
insight
Darshita.
into
The goal
this.
was really here to understand, because we heard lots of different elements you need to implement, potentially changing your legal form, having your equity story straight, having a prospectus, changing your accounting standards, but also making your team stronger with investor relations, legal, and also lots of attention from your C executives. But that's really worth it, I would say. The question was really concerning the pure listing costs. We don't need here an estimate, but we would like to better understand what types of costs are now to be implemented globally.
Yeah, the cost of a listing, you have different items that come on the agenda. Well, first of all, it are the banks, which take a big part of the total cost of the listing. Then you have the auditors, the lawyers, and the stock exchange, of course. But all in all, those costs they remain quite okay, especially if you compare with a trade sale or a PE divestment to another PE. Well, you have also lots of costs which come into play at that point in time. And it's more an investment. You have to see this as an investment for the future growth of the company. And I think that Jean made a good point in this respect on you have to strengthen your company, strengthen the governance, but that makes also the company stronger in as a whole. So it's not only the fact of having to hire some more people, but your company is reinforced through that stock listing.
Yeah, I would agree. I mean, we had to hire, as I mentioned, a couple of people. It's not that much. Obviously, the initial cost is more important, as Benoit mentioned, but you can really kind of see it as a long-term investment. And as a whole, I think we are a better company now than we used to be before, because, as a management, I think you get a lot more involved. You get skin in the game because you have options, you have invested yourself. In our case, we were obliged to invest personally some funding into the company. So you feel much more embedded in the performance of the company. So yeah, it's cost, but it's well spent. And I think it will also allow you to be in better place in order to do M&A and be stronger for M&A. And I think that was mentioned by Benoit as well as one of the reasons to go public. And clearly, it gives you a better currency when you are public and you're performing well than if you are private.
Great. I think we can all summarize that this investment is definitely going to reap benefits as it has for Shugart. I think we are at the end of the session. We do not have any more questions. So thank you very much to all our speakers today. This has been a very good, insightful session. Indeed, I hope for all our participants as well. I think I'll pass on to Stefan to conclude.
Thanks a lot, Darshita. It was really a very efficient session. And also thanks a lot, dear Paul, Jacques, Jean, Thomas, and Benoit for this very interesting insights and for sharing your practical experience. We'll just now finish our session with a quick snapshot of the next LPA events. Next week and then the weeks after will be quite busy. We'll have our AGM, so on the 8th of June. Afterwards, we'll continue with a career adventure webinar with the young talents who will pursue the discussion of our latest job fair. Our academy with different trainings on valuations, fund of funds, risk management, ISG, and also private equity expert training will start on June 14th. Afterwards, we'll also move on to the VAT developments in Luxembourg and also Europe via a dedicated private equity webinar. And finally finish with different Polish VCs interested by the Luxembourg Hub. So we hope that you enjoyed today's webinar and hope to see you very soon again. Thanks a lot.